What's good, everybody? It's your boy JTL, Opposite from the Norm. And real quick, I just want to let y'all know about Opposite from the Norm apparel t-shirts. Brought to you by GFam G-Wear. You like our show and our content? Then go to gfament.com and click on G Store, and there you can purchase an Opposite from the Norm t-shirt. Also, you can check out other great tees that represent true kings and true queens as well. Shirts that motivate and make you feel great. Once again, that's gfament.com and click on the G Store link to get your apparel tees. Now back to the show. Chill.
Yo, what's good, everybody? It's your boy JTL, Opposite from the Norm. About to bring to y'all another great financial Friday with my boy HD. So y'all get your pen, pads ready, get ready to hit your Google search and try to, up your game when it comes to your finances. You know what I'm saying? You don't have to stay stuck in your same situation. So without further ado, let me go ahead and get my boy HD in here, start dropping some knowledge on y'all.
What's up? What's up? This your man HD, and like my homie just said, I'm about to hit you with another Financial Friday. This one is gonna be a little intricate, so you may have to listen to it a couple times over. Well, I'm gonna try to drop as much knowledge on you as I can in the quickest form. This week, I'm going to do Financial Friday on CDs. Not the CDs we used to listen to back in the 90s that you throw out the window. CDs in the bank. So a CD is a certificate of deposit. It's for a product offered by banks and credit unions that provide an interest rate premium in exchange for the customer agreeing to leave a lump sum deposit untouched for a predetermined period of time. Almost all consumer financial institutions offer them, although it's up to each bank which CD term it wants to offer, how high the rate will be compared to the bank's savings and money market products, and what penalties will apply for early withdrawal. Speaking of the interest rate, it's a lock rate that are positive in that they provide a clear and predictable return on your deposit over a specific period of time. The bank cannot later change the rate and therefore reduce your earnings. On the flip side, a fixed return may hurt you if your rates low, if the later the rates rise substantially and you've lost your opportunity to take advantage of paying CDs. The terms of these CDs. This is the length of time you agree to leave your funds deposited to avoid any penalty. The term ends on the maturity date. That's key. When your CD has fully matured and you can withdraw your funds penalty free. Principal. With the exception of some specialty CDs, this is the amount you agree to deposit when you open the CD. The financial institution. The bank or credit union where you open your CD will determine aspects of the agreement, such as early withdrawal penalties and whether your CD will be automatically reinvested if you don't provide other instructions at the time of your maturity date. All right. So, how are the CD rates determined? Federal Reserve Board's rate settings actions loom large in terms of what savings can earn on their deposits. That's because the Fed's decision can directly affect a bank's costs. Every 6 to 8 weeks, the Fed's Federal Open Market Committee, which is the FOMC, decides whether to raise, lower, or leave alone the federal funds rate. This rate represents the interest that banks pay to borrow money through the Fed. When the Fed money is cheap, banks have less incentive to court deposits from consumers. But when the federal funds rate is moderate or high, banks can do better by paying consumers a competitive rate for their deposits. The CDs are one of the safest savings or investment instruments available for two reasons. First, the rate is fixed and it's guaranteed. So there is no risk that your CD's return will be reduced or even fluctuate. Whatever you signed up for is what you get. It's in your deposit agreement with the bank or credit union. The CD's investments are also protected by the same federal insurance that covers all deposit products. The FDIC provides insurance for banks, and NCUA provides insurance for credit unions. When you open a CD with the FDIC or NCUA insured institution up to $250,000 of your funds on deposit with that institution is protected by the U.S. government if that institution were to fail. Bank failures are exceptionally rare these days, but it's good to know that your bank failure won't put any of your funds in jeopardy. So now I'm going to go over a few of the cons of these CDs because I always want to make sure that, I'm not just spitting out just the good, give you the bad. Your CD cannot be liquidated before the maturity date without incurring an early withdrawal penalty, which I spoke about earlier. Typically earns less than stocks and bonds over that time, which is something to think about if you're interested in stocks and bonds as well. Also, it earns a fixed rate of return regardless of whether the interest rates rise during that term. Next, I'm going to go to how much do you need to open a CD. Each bank or credit union, whichever one you choose, establish a minimum deposit required to open each CD on its menu. Sometimes the bank will set a minimum deposit policy across all CD terms it offers, while some will instead offer rate tiers, providing a higher APY to those who meet higher minimum deposits. What happens when your CD meets that maturity date I spoke about? In the month or two leading up to your CD's maturity date, the bank or credit union will notify you of the impending end date. Once they communicate that with you, they'll also include instructions on how to tell it what to do once you hit that maturity date. Typically, it will offer you one of three options. The first option they'll offer you would be to roll over your CD into a new CD. Generally, it would be into a CD that most closely matches the term of your maturing CD that you already have. So, for example, if you have a 15-month CD, they'll most likely try to roll you into a balance that goes into 18 months or another year. You can transfer the funds into another account at that bank, which is the second option. That includes a savings, checking, or money market account if you want to go that route. Lastly, you can withdraw your proceeds. Then they can be transferred to an external bank account or mailed to you in a paper check form. There are also different types of CDs that they offer, which they call specialty CDs, which are bump up CDs, add on, no penalty, jumbo, and IRA. So all those are things that whenever you choose the bank or credit union in which you're going with, you can ask them about those. So that is just a broad overview for today on how and what a CD is and how they work. So if I were you, if this is something that you're interested in, you should check around. You don't necessarily have to use the bank that you use right now. You could use a different bank or a different type of credit union because you may find that a credit union or a bank across town may have better rates or better terms that you can use. All right, so we're going to end today's Financial Friday. You can get some more information on CDs, whether you bank with Bank of America, BB&T, or any of these other banks. They have that on their website. You can also use Investopedia, and you can also go to other financial institutions like Merrill Lynch, and they'll have a very, very detailed breakdown of the CD, a little bit more than what I went over. Because if I go through everything, you'll be on here with me for an hour. And I don't want to do that to y'all because I know y'all busy, got shit to do. All right, this your man HD signing off for this week's Financial Friday. I'll be back next week, giving y'all some more financial information so that my black brothers and sisters can go out there, make money, get rich, do your thing. I'm out.